To Norm, concerning long-term investing, where would you recommend someone can invest that offers a high return but some safety in this chaos? Good luck, Norm. I'm not an investor, but good luck.
Well, that is a good question. One of the things about investing we always have to remember is that you have to get your investment or your risk or your return is directly commensurate with your risk. In other words, the higher the return, the greater the risk. It has always been that way and will always be that way. That's why the return is high, and because the risk is there. So for taking that risk, you get a good return. You know, if you want like 100% or if you want 100% return on your money, we can find a lot of different investments, but it's pretty risky out there. But if you're talking just about your general investments nowadays, the thing we have to come to the grips with is that our current financial system right now is not offering a lot of return, and that simply is because they're trying to keep interest rates down so that they can stimulate the economy, stimulate borrowing, and when people borrow they spend, and so on and so forth. So your stock or your bonds and even your municipals and things on that order, corporate bonds, your interest rates are all pretty low right now because they're trying to stimulate borrowing and spending. So you're not going to have a lot of high returns. Right now, what we recommend is that in this environment, we're more interested in return of your investment rather than return on your investment. The stock market itself, for example, some people have gone back into the stock market. We have to realize that in the early 2008, right after the subprime crises hit, we saw a 60% drop in the stock market. Well, whenever an investment goes from here to here very quickly, we have to understand that that's an artificial wealth. It's not a righteous wealth, because godly biblical wealth or righteous wealth is not here today and gone tomorrow. So artificial wealth, when you see the stock market crash 60%, you have to understand that was a bubble. It was a debt bubble because there was a lot of borrowing and buying of stock, and then when the financial system was shaken, and by the financial system, that's different than the economy. The economy is Main Street, the financial system is Wall Street. And when I say the financial system, I'm talking about the system's ability to get money into investments or into the economy or into whatever you're trying to move it in there, like real estate. And when that system shook and all of those subprime mortgages began to collapse, then what happened was lenders just tightened up and they weren't lending money anymore. And because it was the overspending of the debt, or I should say over borrowing and then spending into those investments, that caused it to the prices to go up, artificially inflate. When the lenders stopped lending, what happened was that those artificial values came crashing down. And so then the government steps in because Wall Street and Main Street were in trouble, and Wall Street pretty much had failed, and so Wall Street and the banks weren't lending money, so the government steps in because the government's the only one that has a big enough balance sheet to come in and borrow enough money to spend in the economy to kind of get it going. And a lot of that money in the QE1, and now they just announced last week QE2, where they're going to pump another $600 billion into the economy. A lot of that, it doesn't get into the economy, which is obvious because of the unemployment and the slowdown and so on and so forth. So where is it going? It's going into the stock market. And it's going in through the different investment houses and so on and so forth. They're taking a lot of that money and they're putting it in the stock market. That's why we had a stock market rally. Came back up to about 11.6, 11.7. Now it's down around 11.1 or 11.2. And that is a bubble also.
So it's artificial.
It's artificial. And so they can keep this thing kind of leveling around the 1100 or 11,000 range. But what we're recommending is don't go back into that yet. Kind of go to the sideline, so to speak, for right now, and let's see how this thing flushes out.
Somebody's bound and determined that they would like to be involved in stocks. What about the classic things that conservative people thought of? Utilities, because people are going to use energy no matter what, or I'm not going to name a name, but say somebody who makes staples like bread or deodorant or the things of life that get reused all the time. Is that not even safe?
Well, those are better for sure. If you're going to go into the stock market, I would probably say get into companies that are international in nature, because some of your emerging markets like South America and Asia and things on that order, they're still going fairly well. And so, because those companies do a lot of work and a lot of business overseas, they're probably going to be a little bit more stable a little bit longer. But those are going to be shaken too, because their economy and the way they're going is built on a debt bubble. Everybody's borrowing money to spend, and that means the debt's going up.
So Andy, play it safe, my friend. Play it safe.